Good afternoon, dear all. Yesterday we have learned about derivatives market. Today we will be learning about commodities market. Now, before starting with commodities market, whenever we are talking about financial markets, there are lot of markets. These markets are named according to the instruments that you deal with. See, if you are dealing with derivatives, we call it as derivative market. If you're dealing with financial instruments like commodities, we call it as a commodity market. Now, before going to commodities market, first we would learn what is commodities. See, whenever we are talking about commodities, in commodities market, whenever you're talking about commodity, it is any material which can be brought and sold, but that doesn't mean that you can sell anything into the commodities market. You can sell only movable properties, right? Which are not money, which is not securities, which is not actionable claim, any movable property which you can transport from one place to other place. When you are talking about only that kind of material, we are talking that kind of material as commodities. Now, whenever we are talking about these commodities are the materials which are used by human beings for their specific needs, or these commodities represent the elements which can be used by human beings for fulfilling their necessities and things like that. So these commodities include materials like gold, silver, copper, zinc, aluminium, or even it can include agricultural products like coffee, pepper, cashew, right? Or it can include something called as maize, paddy, or it can include natural resources like oil, petroleum, crude oils, and things like that. So whenever we are talking about commodities market, it can include any commodities like hard commodities, like whenever you're talking about gold, zinc, they are hard commodities. Or you can talk about soft commodities, which talks about oil, coffee, and things like that. So whenever a market which deals with such kind of commodities, where you can trade or you can buy and sell such kind of commodities into the market, we call such kind of commodity, what we call such kind of market as commodities market. Now, what happens in commodities markets is commodity markets allow producers and consumers of a specific commodity or a specific product to gain access to this market. That is, buyers and sellers meet in this market in order to fulfill their needs of either buying or selling the products. Now, in commodities market, we have other players also who will be helping out in hedging, or who would be helping out in arguing, things like that. So whenever we are talking about commodities market, a commodity market is a marketplace, right? Which can be either a physical market. See, if you're talking about agriculture products, or if you're talking about physical commodities, we have certain physical. See, whenever we are talking about vegetables, whenever we are talking about fruits, or whenever we are talking about flowers, we have a physical market into existence. So a commodity market is a marketplace where you can have physical market, or they can be a virtual market also. If the commodities are not physical, or if the commodities are not of perishable nature, you can have virtual commodities also. Now, in this marketplace, which can be either a physical or a virtual marketplace, traders can either sell or buy any kind of commodities which are either raw or which are primary goods like rubber, wheat, gold, right? With which, or they can be any kind of manufactured goods also. So whenever we are talking about commodities market, this commodity market basically consists of two types of market. You have something called as spot market. You have something called as derivative market. Whenever you're talking about spot markets, these are the markets where goods are immediately transferred or delivered to the buyer after the payment is made. Usually they are named as mandis, wholesale markets, right? So this spot market or wholesale market is a marketplace which comes into like a physical marketplace where buyers and sellers meet, buy and sell the goods, and the delivery will be done immediately after inspecting that specific commodity. But there is something called as derivatives market also. What is this derivative market is? It is complete opposite to spot market. In derivatives market, the financial instruments or the commodities are financial in nature, right? Whereas derivative is an agreement, we have learned yesterday, wherein the value of that contract or the value of that agreement is determined by the underlying asset value. So the commodity market can also be a derivatives market, which not only deals with the already existing goods, but it can also deal with future goods. So this commodity markets can have something called as future commodities contracts, or they can have something called as forward commodity contracts, or option commodity contracts, depending upon what
which contracts are they entering into? Are they entering into futures? Are they entering into forwards? Are they giving you an option? Depending upon that, you can call it futures commodity, forward commodity, or option commodity. So whenever we are talking about commodities market, if you are delivering the goods, or if the goods are delivered on the spot, we call it as spot market. If the goods are delivered at a future date or promised to be delivered at a future date, we call it as derivatives market. Now, whenever we are talking about commodities market, what types of commodities are sold in the commodities market is, commodities are just like any financial assets like bonds, stocks, right? But these commodities are categorized into 4 categories. You have 4 different kinds of categories when it comes to commodities market. You have something called as agriculture commodities. You have something called as metal commodities. You have something called as energy commodities. You have something called as livestock or meat commodities. When you're talking about agriculture commodities, these commodities are materials, or these commodities are what do you call as things which come from an agriculture output. Like you have something called as wheat, rice, soybean, cotton, cocoa, rubber, sugar, right? Any such item which is agriculture based product or which is agriculture based material, they are categorized as agriculture commodities. If you are talking about metal commodities, it includes all the metals like copper, silver, gold, platinum, zinc, aluminium, any kind of material which is found or which is extracted from mines. That materials are called as material commodities. Apart from this, you have something called as energy commodities, which comprises of natural gas, crude oil, petroleum, right? Or gasoline, which is extracted from the mines, or which are extracted from the gas lines. Those are called as energy commodities. Or apart from that, you have something called as livestock or meat, which talks about cattle, right? Which talks about livestock, like fishery, what do you call as cattle fields and things like that. Those are classified as livestock and meat commodities. Now, apart from these 4 classifications, that is agriculture, metal, energy, livestock, and meat, there are other commodities also. You can classify them, or you can segregate them into 2 types. One is soft commodities. Whenever we are talking about soft commodities, they are the commodities which are based on agriculture products. You can either classify them into first 4, that is agriculture, metal, energy, livestock, or meat. You can classify them into the second time, that is 2 types. One is soft commodities, where you're only talking about agriculture products and livestock, or hard commodities, where you're talking about the metals, mines, or energy resources which are extracted from agriculture products. Now, whenever we are talking about the commodities market, the features or the characteristic properties of commodities are, see, whenever we are talking about commodities, all commodities cannot be traded on commodity exchanges, because some commodities are fungible. That is, you can identify them into individual units. They have that characteristics of tangibility. That is, you can see, touch, feel them. But not all commodities are the same. So therefore, what are the important characteristic features for those commodities which can be traded into the commodities market are, the first one is tangibility or homogeneity. See, any commodity that you want to trade, or any commodity that you want to exchange on a commodities market, that should be homogeneous. That is, they should be of similar nature. They should be tangible, in the sense you should be in a position to identify it. You should be in a position to see it, or you should be in a position to substitute it with something else. For example, if you're taking gold as a commodity, gold is something which can be seen. Gold is something which is homogeneous, right? Gold is something which is commodity, right? So any product which can be seen, which can be felt, or which can be touched, or which is of similar nature, only those commodities can be traded on commodities market. Next comes durability. See, a commodity should be something, or a commodity should be a product, a commodity should be a material which will last for a long period of time, that is more than 1 year. Any product, any material which cannot last for more than 1 year, you cannot call it as a durable product. So commodities to be exchanged on a commodities market, it should have a durability of at least 1 year or more than 1 year. Next is gradability. See, the commodity should be suitable for grading. What does that mean? See, if the commodity cannot be segregated into grades, grade 1, grade 2 product, grade 3 product, it will be very difficult to trade these products into commodity, because gradability is something which comes with purity. Gradability is something which comes with, what do you call as, the quality of product that is available. So grading should be possible. It should be suitable for grading. Only then you can call it as a commodity. Not only that, there's something called as open supply. Whatever commodities you want to exchange on a commodities market, that commodity should be freely available. That commodity should be openly supplied, right? There should not be something called as a monopolistic market, nor these supply or prices should be controlled by the government. They should be openly available. They should be widely placed, or they should be freely available in the market. Only that kind of commodities are called, only that kind of commodities can be exchanged, or only that kind of commodities can be traded in the commodities market. Not only that, price fluctuation is an important characteristic feature of commodity. See, the price of these commodities which are traded on the commodities market frequently fluctuate. So there would be speculators who would be speculating, or who would be participating, right, in order to identify this price and provide liquidity to the market. So price fluctuation is also one of the important characteristic feature of commodity. So if you want to know which kind of commodities can be exchanged into a commodities market, they should be tangible, there should be homogeneity, there should be durable, there should be gradable, there should be an open supply of all these materials, and there should be price fluctuation. Only then you can call it as a commodity. Now next comes spot market. See, whenever we are talking about spot market, I told you this regular mandis, wholesale markets are the places which come under spot markets. Agriculture markets like your Raitu Bazaar, or what do you call as, the markets that establish in your locality, those are the best examples of spot markets. They are established in most parts of the India. Now, these agriculture markets are regulated, or these agriculture markets are controlled by State Agriculture Produce Market Committee, which is called as APMC, Agriculture Produce Market Committee. These committees are constituted by the state governments to manage the markets within the market area of the state. Right? Within the state market area, every state government manages this agriculture products. Now, what happens in this markets is wholesale marketing activities cannot be carried out by either an individual or a specific agency in that specific area if you call it as a market area. Therefore, there is a committee which is constituted. This is a statutory market, that is, it is a legal market which has been established by the state government in order to deal with any product related to agriculture, horticulture, or livestock products, right? Oh, that kind of products can be sold in agriculture markets. Next comes commodity derivatives market. We have already learned about derivatives yesterday, so we are not going to learn in detail about this derivatives market. But because it is a commodities derivative market, we will understand a gist of what happens in commodity derivative market. See, whenever we are talking about the derivative markets can be derivatives can be in the form of forwards, derivatives can be in the form of futures, derivatives can be in the form of options. Now, whenever we are talking about forwards and futures are derivatives contracts, right, which use spot market for determining the value of the underlying asset. That is, these are the contracts that give owner the control over the underlying asset at some point of time in the future. So whenever we are talking about commodities forward contract or forward commodities contract, a forward contract is a tailored or a customized derivative contract between two parties, right, which plan to buy or sell any commodity on a specified date at a specified rate in the future, right? Whereas whenever you are talking about commodities future market, it is a market in which future contracts takes place. They are something called as standardized, right? In a future commodity contract is a derivative instruments which derive its underlying value, right, by buying or selling an asset right? At some future date, at some rate of price, or at some price, right? When they plan to buy the future commodities, we call it as future commodities market. Apart from that, we have something called as options commodity market also. When you are given a right, when a seller gives you a right but not an obligation to buy certain commodity in the future at specified time or before the specified time period, we call such kind of commodity markets as options commodity markets. Now, whenever we are talking about the commodities market, who are the participants in commodities market? See, just like because it is derivatives, right? Futures, forwards, and options come under derivatives. The common participators that are available in the derivatives market are also available here also. See, for example, we have hedgers, we have speculators, we have day traders, we have arbitrators, and we have something called as market makers. Yesterday, we have learned that hedgers are the participants who would like to protect themselves from adverse price effects, or who would like to protect themselves from the risk of losing their money. They want their position to be intact. They don't want any kind of change into that position. So we call such kind of participants as hedgers, because they don't want to take any kind of risk about their position. In the simple words, they don't want to lose their money, right? They will enter into a hedger contract where they would like to protect themselves from adverse price effects. We have something called as speculators. Speculators are the people who speculate the change in prices so that they can take the benefit, right, of buying and selling in two different time zones, right? You have something called as arbitrators. Arbitrageurs are the people who purchase and sell in two different markets, right? In order to take the advantage of price benefit, they are the people who look out for quick money by selling the commodities in two different, buying it from one market and selling it in the different markets. Apart from that, one participant that you see in commodities market is day traders, right? They take the position in commodities futures contract and they liquidate themselves before the close of the same trading day. That is, they are the people who enter into the contract. They are the people who get into the contract to make sure that, right, they buy and sell the contract, or they buy and sell the product on the same day and complete the trading on the same day. Apart from that, we have something called as market makers, right? Market makers are the traders. Market makers are somebody who throughout the day bid the prices, offer the prices at the same time for the same commodity. See, if there is X commodity, these market makers are the people who bid and offer the price, right? They bid the price also, they offer the price also at the same time for the same commodity, right? Now, what happens with this market makers is exchange gives privileges to certain market makers, right? What happens is they bring liquidity to the market of a particular product. They are like a special class of speculators, right, who will be working in the market. Now, just like derivatives market, commodities market also has futures contract, forward contracts, and options contract. Now, apart from that, there are certain commodities market that are present in our country. At present, there are 4 national commodity exchanges. Like, you have something called as multi-commodity exchange, right? National Multi-Commodity Exchange is the country's first commodity exchange, right? Now, because it is a multi-commodity exchange, it deals with multiple products, right? Which gets in exchange. Apart from that, you have something called as National Commodity Derivative Exchange Market. Here, the contracts related to futures, contract related to forwards, contract related to options are traded in such kind of market. There is something called as Indian Commodity Exchange Limited. This Indian Commodity Exchange Limited is a market where Indian commodities, specifically it deals with Indian commodities. And apart from that, there is something called as National Multi-Commodities Exchange Market. It deals with multiple commodities at a national level, right? Which they work upon in order to get the market conditions, or which they work upon in order to exchange the commodities. Now, whenever we are talking about the challenges in commodities market, see,
commodities market is one of the biggest market in the country, and there is a phenomenal growth that is happening in this commodities market, right? Because the commodities market has become vibrant in India, right? Because it is not only benefiting the farmers, but it is also benefiting the manufacturing sector. Everybody is gaining the benefit out of this commodities market, but there are some challenges which are faced by Indian commodities market currently, right? The one of the biggest challenges, there is a lack of spot markets, right? There are a lot of middlemen who are involved in this commodities market, who are gaining a lot of benefit rather than the manufacturers or rather than the farmers. So there is a lack of this robust spot market, right? There is lack of awareness among the investors. See, whenever you are talking about current day investors, current day investors are the people, right, who are investing either in derivatives, mutual funds, SIPs, banks, but they are not thinking about the commodities market. So there is a lack of awareness among the investors about the commodities market. There is lack of awareness not only among investors, but there's lack of awareness among the farmers also. There is something called as commodities market. The exchanging of goods and services can be done there, which would be helpful for them, right? Even farmers are lagging behind such kind of awareness, and contract size is large when it comes to especially small farmers. The contract size is very large, which is beyond their capability, and there are a lot of infrastructural challenges. See, for example, when these commodities markets are the markets which require warehouses for them to be stored, and there are very few warehouses, and even if you have warehouses, they are underdeveloped. Therefore it becomes very difficult to store such kind of products into the market. So that is turning, infrastructure is turning out, and commutation also, shifting these commodities from one place to other places, the transportation cost, everything is also turning out as a challenge for a commodities market. Geographical diversity, I told you, movement, logistics, supply chain, all these are the biggest challenges to this commodities market. Not only that, legal and regulatory challenges. See, whenever we are talking about farmers, most of our farmers are not very well educated, so it becomes difficult for them to understand the legal requirements. It becomes difficult for them to understand the regulatory challenges. So though India has a long way to go in order to take the benefits of commodities market, but there are certain challenges. If awareness can be created among investors and farmers, if spot markets are encouraged, and if you remove this infrastructure challenges and legal challenges, this commodities market has a wide scope, right, for development. This commodities market has a wide option for development, which is very, very important. So this is about commodities market. Next comes your financial services. See, till now we have learned about financial markets. If you remember, we were learning about Indian financial system, and in Indian financial system we have financial markets, we have financial services, we have financial instruments. So we have completed with the markets. In markets we have learned about we have learned about markets, which includes commodities market, which include capital markets, which includes money market, which includes foreign exchange markets, and which include derivatives market. So whenever you're talking about Indian financial system, it not only comprises of markets, but it also comprises of something called as financial services also. These are not physical markets, but these are the services which are provided in Indian financial system, right? To enhance the economic ability, or in order to enhance the economic development of the country. So whenever we are talking about the financial services, right, a well what do you call as, if you want any financial system to function properly, right, the fundamental principle is to have a good financial system, right, which is what do you call as, which a good financial system cannot be formed without banking and insurance services. So a healthy bank and insurance service sector will go long way, right, if you want to strengthen the financial system, because this banking and insurance systems provide holistic financial products, which is very, very important for the economic well-being of the citizens. So it is very, very important to understand that Indian financial system cannot be strengthened, or Indian financial system cannot be, what do you call as, Indian financial system cannot be strengthened, or Indian financial system cannot be functioning properly without this banking services or without this insurance services. So first we would be learning about banking services. See, before going to bank, what kind of services that a bank provides, we need to first know what is a bank. See, bank is a financial institution, or simply you can call bank as a financial intermediary, which acts as a party between lenders and borrowers, right? It is a licensed financial institution to receive deposits and to sanction loans or advances to people who need it. So a bank is a financial institution which acts as an intermediary, right? Which is involved in borrowing or lending of money. See, any company which involves itself in lending and borrowing of money, we call such kind of company as a bank. See, if banks have to be defined, or if banking has to be defined, they are the institutions which are accepting for the purpose of lending. They are the institutions which are accepting for the purpose of lending. They are lending money, they are giving investments, they are accepting deposits from the public, which are repayable on demand or in any form like check, draft, or order, anything. See, whenever we are talking about banks, we are talking about commercial banks or investment banks or cooperative banks. When if you are talking about a bank, it should either be a commercial bank, it should either be an investment bank, or it should either be a cooperative bank. Now, depending upon the type, a bank may provide a different range of services, right? Which includes saving banks account, safe deposit locker account. Uh, Two, it can give you retirement planning, wealth management advisors, and things like that. So if you're talking about commercial banks offer a wide range of services, right? Not only managing your deposits, withdrawals, provide you savings account, but they also offer you something called as fixed deposit accounts. They will issue you debit and credit cards. They will give you short-term and long-term loans like car loans, housing loans, home loans, and things like that. So to individuals, they provide such kind of services, whereas to institutions or to corporate clients, they give something called as working capital loans, they give project financing, they give medium term loans, they provide services like cash management, receivables management, factoring, underwriting. This they do for corporate clients. So depending upon what kind of customer are you, depending upon what kind of bank it is, the services vary from accepting of deposits to what do you call as wealth management or retirement plan. Now, what is the importance of a bank in today's financial system, or why banks are important? See, banking system plays a very important role. It is considered to be the backbone of any country's economy. Banking system plays a very important role in modern economy, and it is considered to be the backbone of any country's economy because they collect the savings of the individuals and lend them out to business houses or industries, right? Banks play a very important role. See, what do? They collect the savings of individuals like you, me, right? Or somebody else, and give it to those business houses or industries which establish companies, which establish factories, create employment, increase the economic development of a country. Not only that, banks are the institutions which facilitate commerce. They help in trade. They help in commerce. They play a very important role in creation of capital, right? Which is very, very important for a country's success, right? They cater to the credit needs of the country, right? They play a very important role in providing credits to the society. They are the suppliers of money, because without banks, you don't know where are the savers, you don't know who has the money, where can you get the money. So before banks were established, there was no system or there was no mechanism to identify where the savers are, or there was no system to identify where money was available. So banking system facilitates availability, not only availability of funds, but it also facilitates national trade and international trade also. Now, why banks are important is because banks have a very important role in economic development of a country. See, the role of banks cannot be neglected or the role of banks cannot be ignored in the economic development of a country. Now, what role does it plays is banks promote the habit of saving, right? What does banks do? They give attractive offers in terms of deposit schemes. They give you return, they give you rewards in the form of interest to its customers, which will enable the customers to create a habit of banking or to create a habit of saving. See, if there was no interest that was given, if there was no loans that were given, or if there were no deposit schemes that were given by the banks, nobody will invest or nobody will save their money in banks. So with these schemes, with this return on investment, banks are promoting the habit of saving. Not only that, see, for any country to prosper economically, right, they have to go for what do you call as establishment of factories, establishment of companies, establishment of industries, for which capital is required. So capital is a key element for any business, capital is a key element for any industry, or capital is a key element for what do you call as any kind of organizations. So capital is something without which an organization cannot run. So that capital formation is only possible by banks. How banks encourage capital formation, or how banks help in capital formation, is they collect the deposits from the depositors and convert these deposits into loans for the people who require it. See, I have money. If I'm putting it into bank, what are the banks doing? They're giving my money as a loan to somebody else who is in need of money, so that, right, they can grant advances to the industry. Not only that, banks help in payment and remittance mechanism also. See, whenever you are indulging into trade and commerce, there are a lot of payments that are happening. See, I think all of us use Google Pay, Phone Pays, and things like that. It is not directly going from our account to their account. There is a middleman called as bank who transfers all this money from your account to their account. So banks not only promote trade and commerce, but they also make payments, remittance. They provide you payments and remittance mechanism. Remittance is depositing the money into their accounts, right? A modern bank helps its customers to send funds to anyone or receive funds from anywhere in the world. So they provide something called as payments and remittance mechanism, right? By providing payments and remittance, see, whenever we order something from Amazon or whenever we order something from Flipkart, right, it is the bank which is facilitating the online payment, or it is a bank which is facilitating the payment of money to that institutions or through the companies. So by that way, they are not only promoting payment and remittance mechanism, but they are also facilitating trade and commerce. At sitting at your doorstep, you can make all the kind of payments. Sitting at your doorstep, you can do everything. So they are facilitating trade and commerce also. Not only that, banks are generating employment opportunities. See, because banks are providing capital, because banks are providing investment to industries or companies, they are able to establish factories, they are able to generate employment opportunities both directly and indirectly. Not only that, they are also supporting agriculture development. See, we know agriculture is what do you call as the largest occupation in Indian economy, right? It is an integral part of any country's economy. So previously banks used to cater to the needs of only industries, or banks used to cater to the needs of only individuals. But today modern banks are promoting agriculture products also by giving loans and advances at very low rate of interest. So banks are providing loans and advances to this agriculture industry at very low rate, which is helping them to develop agriculture products. Not only that, balanced regional development is possible. See, because of banks being established in only urban areas are developing at a very great pace, whereas there is a loop-sided development in rural areas and semi-urban areas. So now what happens, banks are establishing their branches not only in the urban areas, we have something called as regional rural banks, right? They cater to the needs of the rural. So it is bringing some balanced regional development, right, in the economy when you're talking about loop-sided development. Now, whenever you're talking about the evolution of banking in India, see, banking is an age-old thing. Formal banking in our country started during the year 1700s. But after starting, it has gone through a lot of changes. It has gone through a lot of evolution. This evolution is defined into three different phases. Pre-independence period, which ranges from 1796 to 1947. Post-independence period, which ranges from 1947 to 1991, and liberalization period, that is 1991 to till date. Now, what happened in pre-independence period is, see, the first bank which was established in India was Bank of Hindustan, which was established in the year 1770, right? Which was located in India's capital. The then capital was Calcutta. In Calcutta, the first bank was established, which was Bank of Hindustan. But this bank failed, right? It could not be operated successfully, so it has to close down its operations in the year 1832. But during the pre-independence period, more than 600 banks have registered in the country, but very few have managed themselves to survive in the market. So after that, the General Bank of India was one bank, right? Audu Commercial Bank was another bank which was established in India, but they could not survive the competition in the Indian markets. So East India Company, right? We were under the rule of Britishers at that point of time. So East India Company has established three banks called Bank of Bengal, Bank of Mumbai, and Bank of Madras. And these three banks were called as presidential banks. So before the independence, these three banks, right, played a very major role in the evolution of banking sector in India. These three banks, which were called as presidential banks, later merged into a single bank in the year 1921, which was called as the Bank of India. See, Bank of Bengal, Bank of Bombay, Bank of Madras. These three were merged together, were brought together and named as Imperial Bank of India. This Imperial Bank of India in the year 1955 was nationalized by the then Prime Minister, Miss Indira Gandhi. And now in 1955, it was named as State Bank of India, which is running till date and which is the largest public sector bank, right? After that period came Allahabad Bank, Punjab National Bank, Bank of India, Central Bank of India, Canara Bank, and Bank of Baroda. But all of these banks were established in the pre-independence period only, right? After the pre-independence period, we have something called as post-independence period. That is after India got its independence in 1947. All these major banks, whether it was Imperial Bank of India, only certain banks were nationalized. There were several other banks which were under the clutches of private individuals, which was a cause of concern because majority of the people's money or majority of the people's share was in the hands of private individuals. So with the aim to solve this problem, government has decided to nationalize all the major banks. So all the major banks were nationalized under the Banking Regulations Act in the year 1949, right? Which had deposits of more than 50 crores. All those banks were nationalized. So in the year 1969, 14 banks were nationalized, right? In the year 1980, 6 more banks were nationalized, bringing the total number of nationalized banks to 20, right? Apart from that, in 2017, all the State Bank of India's, what do you call as substitutes, we had something called as State Bank of Hyderabad, State Bank of Bikaner, State Bank of Jaipur, State Bank of Mysore, State Bank of Travancore, State Bank of Saurashtra, and State Bank of Indore. It had 7 associate banks. All these banks were merged into State Bank of India, right? In 2017, everything got merged up, and by 2010, all the banks were replaced with the name called State Bank of India. That is a major thing that happened. In 1991, a committee was formed, which is called as the Narasimhan Committee, This committee was formed in order to check the banking sector reforms which can be formed. So Narasimhan Committee came up with its recommendations, right, in the year 1991. So that period is called as liberalization period. This liberalization period had seen the drastic change or the drastic reforms in banking sector. So whenever you're talking about the liberalization period, we are still under the liberalization period, right? In order to bring that kind of stability, in order to bring that kind of profitability to nationalized banks, Government of India has decided to set up a committee under the leadership of Mr. M. Narasimham, right, to check what are the reforms that can be brought into what you call as Indian banking sector. The biggest development that Narasimhan Committee came up was to introduce private sector banks in India, right? Based on the recommendations of Narasimhan Committee, RBI has given license to 10 private sector banks, right, which includes ICICI, Axis Bank, HDFC Bank, Global Trust Bank, in order to establish their or in order to introduce private banking into India. This was the major recommendation that was made by Narsimhan Committee. At present, we have 12 nationalized banks in the country, and we have about 21 public, what do you call as private sector banks working in the country. Apart from that, we have something called as regional rural banks, cooperative banks, which are working, right, for the economic development of the country. Now, whenever we are talking about banks, the only bank we can see, whenever in a normal context you are talking about a bank, we are talking about something called as a commercial bank. Now, what is this commercial bank is? A commercial bank is a bank, or it's a financial institution or a financial intermediary which carries out all the banking operations like accepting of deposits, lending of money to the general public, or providing an option for investment in order to earn profits. Commercial, as the name itself indicates, they are profit making organizations who do carry out the business operations in order to make the profit. Now, the two major characteristic features of commercial bank is lending and borrowing. They lend money, right, and they borrow money. They borrow money in the form of deposits. They lend money in the form of what do you call as loans. So they receive deposits from the general public and gives this money to business houses, right, in order to earn profit. At the same time, they also sanction this money to the industrialist as loans, by which also they earn some rate of interest. Now, whenever we are talking about commercial banks, there are three different types of commercial banks in our country. We have something called as public sector banks, we have something called as private sector banks, and we have something called as foreign banks. All the nationalized banks, or all the banks in which government holds a significant amount of stake, we call such kind of banks as public sector banks. Say, for example, Canara Bank, Union Bank of India, State Bank of India, Indian Overseas Bank. All these are the banks which are nationalized, and government has a certain stake in such kind of banks. That's the reason they are called as public sector banks. Completely opposite of public sector banks is the private sector banks. These are the commercial banks where private individuals and business houses have the majority of stake. Government does not have the majority stake, but individuals or private companies have the majority stakes. For example, HDFC Bank, ICICI Bank, Axis Bank, right? These are in the hands of private individuals, or the liability is of private individuals. Next, foreign banks. These are the banks which are established in foreign currency but have branches in our country, or have branches in the other country, like Bank of America, Shanghai Banking Corporation, or Hong Kong Banking Corporation. All these are, see, HSBC, what we call upon. All these are foreign banks. Apart from that, we have something called as development banks. What are development banks? Development banks are those banks which are set up mainly with a reason, with a purpose to provide infrastructure facilities, or to increase the growth of industries in the country. They provide financial assistance to both public and private sector industries, right? What is the objectives of industry development banks is their prime objective is to promote industrial development or industrial growth. See, there are specific banks. If you are catering to the needs of agriculture, you call them as agriculture bank. If you're catering to the needs of rural, we call them as regional rural banks. If they're catering to the needs of industry or for the development of this, we call such kind of banks as development banks. So their primary objective is to promote industrial growth. Their second objective is to develop backward areas. They support industries which are established in backward areas. They support industries which are established in rural areas. Not only that, they plan to create more employment opportunities. The development banks, because see, they are not only working towards the development of industries, they are working towards the development of the country also. So they want to generate more employment opportunities. They want to encourage exports and also encourage import substitutions also. They want to go for modernization or improvement in technology. They promote more self-employment projects. They are ready to give you loans for the self-employment. They want to revive, that is, they want to bring the sick units into survival. They want to improve the management of larger industries. and they want to remove all kind of regional disparities or regional imbalances in development, and to promote science and technologies in order to provide risk capital. See, their major objective is to, or their major concern is to promote industries, promote employment opportunities, promote sick units, right? Remove regional disparities, remove all kind of challenges in development of industries. Their prime objective is that only. Now, whenever we are talking about the development banks, what are the major development banks in India is, see, commercial banks, cooperative banks provide working capital requirements, that is money required to run the day-to-day activities of a company. For those working capital requirements, commercial banks and cooperative banks are providing the loans. But every organization has something called as long-term requirement also. They are not only, see, in order to run any company, you require two types of money. One is working capital and the other one is what do you call as fixed capital. Working capital is used for the day-to-day requirement of a company, whereas fixed capital is used for the long-term requirement of a company. So this commercial banks, cooperative banks provide only working capital loans, whereas large term loans or long term loan requirements are not met by these commercial banks and cooperative banks. So what happened is, they have come up with something called as developmental banks, or they have come up with something called as industrial banks, which provide various long term lending options to the institutions, right? Now, what are these lending institutions is, we have a wide range of lending institutions. For example, we have something called as IFCI, Industrial Financial Corporation of India. Their main objective is to provide money. Their main objective is to concentrate on the development of industries. State financial corporations, at state level, any financial help do you require for a company, or any financial help do you require for a industry, this state financial corporations will take care of. Industries Development Bank of India, State Industries Development Bank of India, that's the reason it is called as SEDB, right? In order to develop the industries within the country, or in order to develop industries within the universe, or within the state, the State Development Banks of India will work up. Apart from that, we have something called as Export Import Bank, right? This Export Import banks are the banks which concentrate on providing funds, or which concentrate on providing capital to export and import related activities. We have something called as Small Industries Development Corporation. See, whenever you're categorizing industries, we have something called as small scale industries, we have something called as medium scale industries, we have something called as large scale industries. So any banks which are catering only to the needs of small industries, we call them as SIDCO, right? And there is something called as NABARD, National Bank for Agriculture and Rural Development. They only cater to the needs of agriculture. They only cater to the needs of rural development, right? This bank is a national level bank which caters to the needs of agriculture, which caters to the need of rural development. See, over the decades, these developmental banks have lost their prominence, right? Because of changing policies, like we have something called as LPG, liberalization, privatization, and globalization. Because today we have foreign players, today we have private players, today we have regional rural banks, today we have something called as commercial banks, which are spreading their wings and which are spreading their what do you call as products availability, or which are spreading their services availability to a larger extent. That's the reason these banks are losing their importance, right? Now, next comes, there's something called as universal bank, right? What is this universal bank? Universal bank is a bank that provides three main services under one roof. See, in banking system, we have different types of banking. We have something called as wholesale banking, we have something called as retail banking, we have something called as investment banking. Wholesale banking only concentrates on wholesale requirements, or provides large scale funds, or caters to the industries. Retail banking caters to the needs of individuals. See, if I am a company, or if I'm an industry, my requirement is large, I require large funds for my company, right? Then I'll go for wholesale banking. If I am an individual, or I am a single person, my requirement is small, then I'll go for a retail banking facility. But there's something called as investment banking. See, my requirement is not large, my requirement is not small, I want to invest my money somewhere else, so I'll go to investment banking. So these are the three different services which are provided by banking industry accordingly. But when these three requirements of a bank are provided under single roof, we call such kind of banks as universal banks, right? That is, we call something called as all-in-one: retail banking, wholesale banking, and investment banking. When everything is given under or when everything is given by a single bank, we call such kind of banks as universal banks. Now, what kind of services that they offer is, they help you in all kind of services like investment. They help you in accepting of deposits, lending of loans. They give you long-term, short-term, medium-term loans. They accept current, fixed, and savings deposits. They provide a large number of services like advisory services, portfolio management. They provide you something called as investment opportunities, travel advisors. So when banks provide you every kind of service, we call such kind of banks as universal banks, right? One of such concept is there's something called as financial supermarkets. What are these financial supermarkets is, they are the supermarkets of retail and wholesale financial services, right? They provide a huge range of services, or they provide a full range of services like banking, brokerage, insurance under one umbrella or under one roof, right? A financial supermarket is like any other financial institutions which provide a wide range of services like everyday banking, lending services, stock broking services, insurance services, investment banking facilities. When one bank provides, see, these days commercial banks are providing everything. These days commercial banks are covering everything. So you can call them as financial supermarkets, right? This model is beneficial because it allows the banks to charge certain fees for various services. Otherwise, you have to go to different organizations, or you have to go to different professionals or institutions in order to get each service rendered, or in order to get each service delivered. So here under one roof, by paying a certain amount of fees, you are getting all kind of services, whether it can be stock brokerages, whether it can be sale of stock, whether it can be buying of gold, anything, right? Not only that, today even banks are offering insurance services. There's something called as bank assurance, right? They provide you insurance services, they pay your premiums, they collect your claims if you want, they do all the kinds of works for you. See, there's something called as, they act as a safe custodians for your valuables, right? They lend loans, they accept the deposits, they provide you advisory services, they manage your portfolio, they manage your wealth and things like that. So under single roof, you are getting multiple options, or under single roof, you are getting multiple things. Because if you are going to if you're going for every service to every new service provider, it is very costly and it is time consuming. So in order to risk that, or in order to reduce that risk of losing customers, or in order to reduce the risk of this, or in order to bring some cost effectiveness, or in order to save the time of the customers, banks have come up with this idea called as financial supermarkets, where they provide all kind of services, right? So see, whenever you're talking about providing of all kind of services, what do they do? Accepting of deposits, providing of loans and advances, helping in payments and remittance. I told you, your online payments. Not only that, they give you services like bills of discount, overdraft facility, locker facility. They give you agency services, they give you depository and brokerage services, they help you in international trade, they help you in foreign exchange services, they give you something called as bank assurance, they give you insurance services, right? They give you consultancy services, things like that, right? Not only that, every bank has something called as corporate banking facility also, right? Corporate banking facility is a range of services which are provided only to corporates, or to the what do you call as companies, or to the industries. They include services like provision of credit, they include services like cash management, right? Or they include services like corporate banking, which is also known as banking, right? Which serves its customers ranging from small to mid-sized uh, business houses, right? What services they provide to such corporate employees, or what services that they provide to such business houses is, they give them credits, they give them loans, they give them what do you call as credit products whenever required. right? They help them in treasury services, that is, they help them to manage their working capital requirements. They help in financing their fixed assets, that is, they help them to manage. See, if the industries require certain projects which are capital intensive, they require huge amount of capital, they provide that kind of capital assistance also, right? They help in employer services like selection of retirement plan, health insurance policies or healthcare policies, right? Some banks even provide the payroll facilities for their employees also, right? Not only that, they provide commercial services like I told you, portfolio management, right? Debt equity restructuring, analysis of real assets, leverage analysis. They help the customers in whatever source possible. So when these services are provided only to a corporate employee, we call it as corporate banking. When these services are provided to an individual or general public, we call it as retail banking. Retail banking can also be called as personal banking. Retail banking can also be called as consumer banking, right? Here, the services are provided to individuals by giving them access to basic banking services like they can maintain savings account, they can maintain fixed deposits, they can borrow something called as home loans. There is something called as automobile financing. They can get credit or debit cards. They can get foreign currency or remittance of services, etc. All these things are done, right? They provide you checks facility, travelers check facility. They give you safe locker facilities, right? Or sometimes even banks are coming up with personal loans, home loans, right? When all these facilities are provided to an individual, not to a corporate company, but to an individual, we call such kind of banking facilities which are provided to an individual as retail banking facilities. So before you go to a bank in order to avail either wholesale banking facility or retail banking facility, that is corporate banking or retail banking, you have to determine yourself whether you want this banking services for you as an individual or whether you want this banking services for your company as a what do you call, as a organization or as a company, right? If you want your services as an individual, you will go for retail banking. If you want your services as a institution, or if you want your services as a company, you will go for wholesale banking, or you will go for something called as corporate banking. But see, when you are talking about corporate banking, corporate individuals can only maintain something called as current accounts, whereas individual investors or individual customers can maintain something called a savings account. So the rules of current account are different, the rules of savings accounts are different, the rules of recurring accounts are different, the rules of fixed deposit accounts are different. So depending upon what is your requirement, depending upon what is the facility that you want, you will choose the banking services either from commercial banks. If you are going for loans for your industries, you can only go for development banks. If you want loans or if you want any kind of banking services for your agriculture, you will go to regional rural banks or agriculture banks. If you want any kind of personal services, if you want any kind of consumer related services, you will go to commercial banks or retail banks. If you want any kind of wholesale services, or if you want any kind of what do you call as corporate related services, you will go for corporate banking. So depending upon things, you segregate the banks. If you want all services to be provided under one roof, you can either go for universal banks, or you can either go for something called as financial supermarkets. These are the places where you can get a wide range of services under a single uh, category, or under a single umbrella. You will get a wide range of services, right? That's all for today. There is something called as primary and secondary services which will be provided to the banking sector, or there are some primary and secondary core banking services which are provided by the banks, that we will be learning in the next class. As of today, this is what we need to learn, right? Thank you.